Hey crypto traders, this is Stefan speaking. Today's lesson we're going to be talking about the fundamentals of risk analysis. Overall, this lesson might be one of the most important, especially for new traders or even slightly experienced traders, and even the most experienced traders, as a reiteration of some of the basics when it comes to risk. So let's go ahead and get started. So first we're going to start with some definitions. Risk, the percentage you're exposing to the market correlating to the reward to make it worth the trade. And then reward is the predetermined amount in correlation to risk to make the trade worth the entry. This is going to be said a lot. Protecting your money is more important for long-term success than gaining. So whenever you take these setups, the risk to reward is very important, because to make it worth, right? If it's a 1-to-1, is that really worth it? Is it a 1-to-3? It just depends on what your trading style is and that. But it's important on your setups to have a defined risk to reward understanding of what your stop loss is going to be up to your take profit or your reward. The next definition is exposure. This is the amount of money you're investing in a single trade. So when you talk about percentages of exposure, that would mean, let's say your account is $1,000, then $100 would be 10% exposure. So the next one is leverage. Leverage is a tool used to manage exposure and risk. It's not a get-rich-quick scheme. So with leverage, you just want to manage how much exposure, and then you can have correlating risk to that. So the definition for stop loss is the point at which your trade is invalidated. So if you're looking at a uptrending trade setup, you want to have a stop loss a lot of times where you know that the uptrend is basically invalidated at that point. A lot of times, like we were talking about, you want to have it with risk. So if you can correlate your risk and the point at which your trade is invalidated with your stop loss, then it's a higher quality stop loss. And then this is important as well. The take profit is the point where you exit the trade to de-risk and decrease your exposure. So when you look at taking profit, yes, it's making money, but the understanding of that, what you're actually doing is de-risking and decreasing your exposure that you have in the market. It's another way to look at it. One saying that is always reiterated to me is, the trader that takes the most profit targets is the most profitable trader, right? If you're consistently taking good profit targets correlated to your risk to reward, the more profitable of a trader you will be. So the fundamentals of entering a trade, we got three things: the entry, the trading plan, and the management of the trade. So the first step is just finding an entry, right? Finding an opportunity in any asset class. This step happens first, but before you enter the trade, an established trading plan happens before the actual entry, right? So then the second step is the trading plan. The trading plan, the basic three aspects of it is the entry, the stop loss, the point at which your trade is invalidated, and then the take profit, the point at which we're going to decrease our risk and then protecting your profits. I mean, that can be, once the trade is profitable, moving your stop losses in profit. Let's say it's very profitable. You can move, your stop loss is very tight at the top, percentages. And then the management of the trade is the third section. So you want to follow the trading plan as closely as possible because it helps remove emotion from trading decisions. Small adjustments can be made depending on the situation using logic, not emotion. It's always better to take a stop loss and move on to another trade. A lot of times when you set up these trading plans, when things do change, you're like, well, no, I don't want to. Well, for that specific trading plan that you had, you want to follow through with that, right? And then if you want to take another setup based off of new information that you are now seeing in the, with new fresh information from the market, then that's one thing. Yeah, just understand, doubling down and trying to take an old trading plan that is invalidated and trying to double down on it is not a good idea majority of the time. It's better to be consistent and disciplined with your management aspects. So these are the three questions you want to ask before entering a trade. Why am I entering the trade? What is the reason, right? Is it a price action reason? Is it a fundamental reason? Is it news? Is it a technical reason? You need to have a good why, right? That's step one. The second question you always want to ask before you enter a trade is, what am I willing to lose, right? The trading plan. What's my stop loss? What's my take profits? What's my risk to reward? And all of that. The third question you want to ask is, how much can I make curiously? And this is in that management of the trade aspect. So you still want to take TPs, maybe at once you've hit for the specific trade setup, whether it be a low time frame, medium time frame, or high time frame setup. You can leave moon bags and so forth. It's just how much I can make curiously is a good way to look at it, because you never want to cut a winner unless the market is telling you it's no longer a winner. So if you're, if you got a really good purchase price and the market's just continuing to go way past, like let's say, you bought Bitcoin at 16K 2 months ago, and now Bitcoin's at 23K. Maybe you have 60 to 80% taken out, but leaving 20% of that specific trade still going, and then having an invalidation, stop loss, and profit at some point, right? But yeah, these are the three questions you always want to ask before entering a trade. So the three areas of importance. This is important for, like, in your trading journals to grade yourself, right? So 33% on each. So looking at, like, in your notes. Okay, why did I enter? Oh, you know what? This type of trading plan I don't really have that much success with it. Maybe I need to change it a little bit. And then with the trading plan, okay, so with this setup, I did this percent stop loss, but really the invalidation was a little bit further. And then with management, did I have emotions? Did I change my trading plan? Did I follow the plan? This is just a good way to, like, grade your trades and to reevaluate which area that you need to work on. Maybe you're really good at making the trading plans but not following through with it. Maybe you're not very good at finding entries. These are all areas that you can improve upon and can help you on your trade success and consistency. So, exposure levels. We talked about exposure earlier. Protecting capital is more important than making more capital, right? So protecting your money is more important than making money. So when we look at the three categories, we have the low risk category. This is 60% of your available capital, little to no leverage. Normal time frame wise is weekly to monthly. You want to do 2 to 3 trades, intra-weekly to monthly. So really, you don't want to, like, force these trades. You want you want really good value. Within a year's time frame, the goal is to, just double this. So these are, like, more so, buying in spot. Really, basically no leverage, and with this percentage, each trade should, like, max be like 6%, and that's max. If you're doing more, maybe that can be doubling. Like, let's say you buy it, like, let's say as an example, we're talking about, there's 16K and it goes up to 20 and then it goes down to 18. Maybe with already taking a PT or two, you could then do another 6% at 18, and so on and so forth. But 6% entries. Medium risk, 30% of your available capital. Here you can start to implement some leverage with 3% entries. 10x max. Normal time frame is like weekly to daily. So these are more for, like, when you say weekly to daily, this is like 30 days up to 12 weeks. So like 1 quarter, 3 month trades, whereas this one is 12 weeks up to 6 months to even 12 months, right? And with this goal here, we want to try to 3x because we are using a little bit more average. So just with off these two, if you make these goals 90% and 120%, you'll make 100% per year, which is a fantastic year, right? But then the last one is the high risk. This is your day trading. So you want to use 1% entries with 10% of available capital, 5x to 30x leverage. Max is what I would recommend. 15x is the recommended highest, but never exceed 30. Normal time frame is hourly to daily. So, some of these trades, you can have moonbags going for even up to 30 days, but really, you want to look at 24 to 48 hours on these. So like 2 to 3 trades, hourly, daily. And then on this one, you want to have a little bit of a higher goal. So 10x in a year's time frame, turning this 10% to 100%. So technically your high risk can initially for the whole year become your 100%, right? Just the high risk. So this is the one that you're trading on the most, your high risk account. And with profits, a lot of times what you can do is you can move your high risk to your medium risk, and with profits and medium risk, you can move it to low risk. The idea is again, we want to protect our money. It's more important than making. So you want to do this. The only situation where I would say really funnel into this high risk more so is if you're in a stage called like basically capital deficiency. So you really don't have that much capital. And it wouldn't matter at much if you lose it or not. It's really not something I would recommend as a coach a lot, but I'm just saying because it will not focus on consistency, and these categories are important as well. But if you only have a couple $100, then I can understand just doing this category to try to build up a decent sized account to start fueling these categories here as well. It really just depends on what type of trader you are, but I would highly recommend this category for really learning how to trade. Because this is where capital efficiency comes in, where you can on 10x or 15x with $100 trade on $1,500, and able to make some money daily, right, and stack that, and what you can make in the day and put in your pocket and stack it on your account, right. And also with these type of setups is where you can do a lot of most of the learning, whereas on these you're basically just looking on a macro time frame and trading the trend, the established trends, and um, and this one more so like the medium time frame trends. So like we talked about last week in the trend analysis um, video, in these three categories, looking more so for like the daily, and like the 4 hour, and then maybe even looking at the weekly a bit. So the golden rule when it comes to risk, when opening trades and establishing a trade, ideally basing your risk on 1% of your total portfolio is ideal. The reason why this is just to keep you in the game, right? So when we talked about the high risk category, so let's say you had $1,000 and that's your 10% of your high risk category. If you take $100 each trade, which would be 1% of your account, and every time, let's say, you do that $100 and you have a stop loss of 1% every time. So you have $99, $99, $99, because every time you take a new trade, you are using 100. You've only lost 10%, so that'd be $10. And if you have one successful trade, with that 90%, then you can get 10% profit and you'll be 99%, meaning one profitable trade counteracts 10 unprofitable trades. So the idea is it's not about being right or wrong. It's about setting consistency and discipline in your trade setups and trading with the same amount of money, so that you can essentially with one win, you can counteract a lot of losses, right? Especially if it goes your way significantly. Yeah, you can be a very successful trader only being right 40% of the time, and even less if you follow the golden rule on risk. Depending on the category and risk and level of exposure and what leverage you use, all correlates to the levels of stop loss and take profit points. You can use basic scaling, entry, stop loss, take profit strategies. And the one that I will share is a 4-point system. The more points, the better if properly managed. But if you're not using any points, just start with a 4-point or even a 2-point to start to work on it. This is a basic strategy here where you can do a 10, 20, 30, 40 percentage scale in or scale out, or a 20, 20, 40, 20. Like I said, the reason for these systems is to help manage risk and exposure on the upside and the downside. So let's say you're looking for a trade setup, and instead of putting all 100% in, you can have scale ins, right? So 10% here, 20% here, 30% here, 40% here. And let's say it only hits, you know, 10 20, and 30 and doesn't hit the 40, well, you still got 60% in the trade, and now you didn't even hit your full average buy-in yet, so you gave yourself more of a room for your invalidation on the stop loss. If you So this one's the more conservative, and this one is like whereas this one's a little bit less conservative. It's still pretty conservative, but the 20-20-40-20 scale in. So let's say you only got 3 on this one, you'd get 80% in the trade. So and you can also use this on take profits. So just it's just a good strategy to implement. The more, like I said, the more take profits, the more profitable you are, the more scale ins, the less risk you are taking on, right? Let's say it only hits the 10% or only the 20%, and then the trade goes your way. That's a fantastic trade. So this can help manage your risk and exposure. So yeah, like we said, important things to note: protecting your money is more important than gaining money with trading and investing to be a successful long-term trader. Try your best to make all decisions based off logic and not emotion. So based off your trading plan, not how you feel about the market. If you find yourself in an emotional position, the best thing you can do is protect your money and reevaluate with logic in the future. That being said, one thing I'll say in the management part, when we look at the management part here, management of the trade, um, with new data that arrives, like while you're watching, you can make little changes, like we said here, right, in the management. And that's fine as long as you're basing it off of logic and not emotion. So you really have to rewire your brain as a trader and understand the difference between how you feel and what you're actually reading and seeing from information shown to you. So if you find yourself in an emotional position, the best thing you can do is protect your money and reevaluate with logic in the future. So it's very important to be honest with yourself. An emotional position a lot of traders can find themselves in is sticking to a position or a setup because they just want it to be right. Right. At the end of the day, it's not about being right or wrong. It's about making money. So you want to protect that money, and if it goes the right way and your setup was correct based off of your entry and trading plan, then that's fantastic. But you do want to try to not be in an emotional position. Always learn from your mistakes. So if you're making a common mistake in the entry, the trading plan, or management, find a creative way to cut out that mistake and make more efficient decisions in the future. The biggest thing is don't repeat the same thing, right? Like that, that can be like insane, right? So like the definition of insanity, trying to expect a different outcome with applying the same, concept. So if you find that you're having issues taking stop losses, then just take setups and then always take the stop loss, right? And don't allow yourself to deviate from that, because there's confidence in being consistent and knowing you can protect your money. And let's say you overexpose, you use too much money. Well, then work on just doing smaller trade setups. There's a saying that says, if you're taking a trade and you are worried about it, if you have worried out fear about it, then that means you're trading with too much money. So you need to lower that exposure because you're not willing to lose, right? Like we talked about in the 3 questions, what am I willing to lose? That is very important, because if you're not willing to lose, then you can't be willing to gain. Um, so that's a very important concept. So when we looked at like the goals, right, when we were talking about with the exposure levels, if you only had $1,000, after 1 year you make 100%. That's 2,000. In 10 years you can hit $1,000,000 with the start of only 1,000, with just making 100% every year. So if you can implement strategies to be consistent with getting 1 to 2, you technically can do the same thing all the way up. It does get a little different when you start to enter this category because you are doing more liquidity. But it depends on what exchange you are trading on and what token. And for the most part, on the large ones, this is still not that much, so you should be okay. But yeah, so this is the lesson on fundamentals of risk analysis. If you liked it, please subscribe and comment any questions and concerns. Thank you guys for watching, and I'll see you guys next time.